Hey, good morning everyone. Welcome back options traders and happy Thursday. And I wanted to talk very briefly about the dangers of VIX spreads because I'm getting a lot of questions from traders saying, hey, with all the recent market volatility and the upcoming election, markets could get very volatile. And what if the markets spike from 30 to 85 on the VIX like we did back during coronavirus? Could make a lot of money. And that's very true. But then they say, just in case I'm wrong, maybe I should use some type of a spread to limit my risk. And that's where the dangers can lie. So what are some of the dangers of trading VIX spreads? So remember that the VIX stands for the volatility index, and it simply measures the volatility of the S&P 500 or the SPX. One of the problems, however, is that the underlying are futures contracts. It is not the VIX. And so right off the bat, traders get into some very weird pricing relationships, and that can cause some problems. So for instance, over in the E-Trade platform, now today is Wednesday, October 28th of 2020, big spike in the VIX, up almost 7 points, trading at 40.33. So let's take a look at the November 11s right here with 14 days to expiration. So if the index is at 40.26 now, you would think that the $30 calls would be trading for $10.26. That's the intrinsic value, or at least the apparent intrinsic value. But look over here. It's $7.39. So it looks like it might be a really good deal, trading well below intrinsic. And again, the misperception here is that people think that this strike, this $30 strike, is tied to this index, and it's not. It's tied to a futures contract. And if we went to look at the futures contract, we would see that it would be trading for intrinsic plus a little bit of time value. So again, I just wanted to show that one of the problems is that you're not tied to the index, you are tied to futures contracts. And so this poses a big problem when traders turn to spreads. And the irony is they think that they're making it less risky by using spreads when they could actually be stepping into a very big trap. So again, the reason that they like these spreads is that spreads generally have limited risk. And that's true for the stock market, but it's not true for the VIX. Okay, for the VIX, you might actually have unlimited risk even with a spread. Which kind of spreads? Well, spreads with two different expirations will have this added risk. This is the big danger you have to watch. If you are using spreads on the VIX and you have two different expirations, such as with calendar spreads or diagonal spreads, you can have some very big discrepancies in those prices and actually end up with very big losses, even though it appears that you're right. And the reason is that you have two different futures contracts that you're tied to. So for instance, let's say that you buy the December 35 strike and you sell the November 35. Here we have the same strike, 35, but we have different expirations. This is the trap that I'm talking about. This is a calendar spread or a time spread. And normally if we bought the December and sold November, it would cost us a debit and that would be our maximum loss. But that would be true for the stock market, but not for VIX. And the reason is that you have two different futures contracts and therefore two completely different sets of supply and demand. And your contracts might invert. And what I mean by that is, normally in the stock market or with stock options, December calls would cost more than November. And that will not always be true in the futures market. So you might see that the VIX is in fact starting to spike, which is what you thought, but the December is only going up so fast, but November is skyrocketing. And because that's the option that you're short, you're actually digging a bigger hole, even though you're correct. And because of this potential risk, the fact that you really have two different sets of supply and demand, that many brokers will margin you for a naked position. Kind of interesting, even though you're saying, wait a minute, options have limited risk, and a spread limits it even more. Why are you margining me for a naked position? Why? Because you are dealing with VIX options and you have two different expirations. So if you wish to use spreads, what are some techniques and some strategies you can do? Well, one thing is to use VXX or VXZ. Now these are ETNs, exchange traded notes, so there is no tracking error. So that's a big benefit right there. So the first one on the list is the VXX, and it looks at 2 near-term VIX contracts. And it does a weighted average so that it's always behaving like a 30-day contract. And that's how it's calculating this volatility level. So it's essentially looking at 2 different contracts, but weighting them to behave like a 30-day. Now, technically, they have to have more than 23 days, but less than 37 days. But that's kind of the idea, is that it's a short-term trading index on the VIX, but it's an ETN. And because you're always tied to the same ETN, you're not going to have these problems. If you want to go longer term, you can use the VXZ, and that uses the same idea, but with months 4 through 7. It's going to do some type of a weighted average, come up with a calculation, and say, here is our VIX number. Now, the VXZ is going to behave more like a 6-month option. It'll sort of track the VIX 6M, which is another index that looks at the 6-month volatility. But in both cases, whether you're trading VXX or VXZ, the spreads will behave like stock spreads. The longer dated option's going to cost more. The amount that you paid is the amount that you can lose. All of the principles that you're used to seeing in the stock market will apply to VXX and to VXZ. And the reason is that all options are tied to VXX or VXZ. And see, that's not true for the VIX. That's the one thing you have to be so careful of when you're trading the VIX. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. There's also a brand new candlesticks course for 2020 for those interested in candlestick charting. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.